What is active versus passive income? That's one of the first questions I ever asked Derek as I was getting into real estate investing. And that's a question that he often gets with his clients too, is what expenses, what actions actually qualify for active versus passive, and who can qualify to take those write-offs too. So that's what we're answering today in this episode. Welcome to Office Hours, a tax strategy podcast by Fujikawa Associates, where we simplify taxes for professionals and investors alike. My name is Josh, and I'm a real estate investor and one of Derek's tax clients. And today we're so excited because we are launching his podcast all about tax strategies. So let's bring Derek on. Hey, Derek, how you doing today?
Good, thank you. How are you?
I'm good. For those who don't know you yet, can you tell us a little bit about yourself?
I'm a CPA here in the Silicon Valley and also a relatively new real estate investor. We just got into real estate and we currently have a triple net commercial property in New Mexico and 3 midterm rentals here in California. And I really enjoy helping others with their tax strategy.
Fun. So you brought up something that's pretty interesting to me. So you've been a CPA for 25 years, yet you said that this is a recent endeavor into real estate investing. How recent is recent?
We bought the commercial property towards the beginning of the pandemic, sometime in 2020, and then got into the residential rental real estate market late last year. Really, we finalized the deals in January of this year.
Was there something that in particular that really sparked your interest in investing in real estate?
The funny thing is, it was one of your podcasts that really got me into it. Watching your podcast with Jesse Vasquez and the midterm, that hit a couple of nerves with us. We're always thinking about real estate, but my wife's family is really, almost her entire family is in the medical field. And so the travel nurse market appealed to us because she has a background and we're really familiar, but not necessarily with travel nurses, but the medical profession. And so that got the wheels spinning in our heads and started us this path.
I actually didn't even know that story, so that makes it even more fun. But I know that as people are listening to more podcasts, more YouTube videos, and Bigger Pockets has absolutely blown up and really made investing, especially whether it be in-state, out-of-state, and different asset classes, very approachable and attainable. I'm sure the question of, okay, I have a W-2 job and I'm also investing in real estate. And everyone hears that real estate, one, is great for building wealth, but also is a tremendous tax vehicle. And so what is really the difference between my active income on my day job and real estate income?
There's multiple types of income, but when we're talking about your day job and real estate, we're talking about active and passive income. Active income is any income where you're actively participating and working to get that income. So your W-2 job, if you have a business, something like that. Passive income is more of an income where you're not necessarily doing the day-to-day work, but generating income from that. Some people might argue that real estate is you're doing day-to-day work, but the IRS defines real estate as passive income. So there are a few loopholes and ways around that, but in general, the IRS defines real estate as passive income. So if you have a rental property, most likely it would be considered passive income.
What other examples of passive income are there, even outside of real estate?
Investment income would be considered a passive income. You just buy a stock or an investment and then it earns money and you're not actually doing anything to create that income. You're just relying on the performance of that investment or the work of others to generate that income.
So for example, if there was a dividend stock that you invested in, would it also be fair if you invested into a different company and you got distribution from that as well, that you're not an active participant in? Would that also be an example of passive income?
Investment income is passive. It falls under a different bucket as defined by the IRS. So there's basically 3 different types of buckets. There's investment income, active income, and passive income.
Interesting. So there's your active income, your investment, and then your passive income. What things fall under the investment bucket then?
So that would be like what we were just talking about, like a stock investments or stocks, bonds, even real estate. If you're buying it as an investment, strictly as like a buy and hold type investment versus rented out as a passive activity.
Let's talk about the differences between active and passive. How is active taxed differently?
The income side is not much difference. And in fact, the deductions and everything are basically the same, but the way that losses are treated are significantly different. So if you have an active business, if you have losses on that, you can take that against any other income that you have. So your W-2 income, your investment income, even the passive income, that can all be deducted. Passive losses are pretty heavily limited. In general, passive losses are not deductible, but there is a provision in the IRS where if your income is between 100 or under $150,000, you can take up to $25,000 of passive losses against your ordinary or active income.
Oh, interesting. Is this your individual or is this a joint income limit now?
So it's individual and joint. So this is one of the marriage penalties that the IRS has. It's $150,000 regardless of your filing status. Although if you're married filing separate, that is cut in half to $75,000.
Gotcha. So the other thing that most people hear about once they start investing is that there is something called real estate professional status. What is that?
That is a way to actually turn that passive income or losses into active income. And so when you're a real estate professional, basically that is your job. You're managing real estate as your profession. There are some pretty strict limitations on it, but if you qualify, then all of your losses through your real estate can be deducted against other income.
What things would allow you to qualify to become a full-time real estate professional?
You have to dedicate more than half of your time to the real estate. If you have a W-2 job, a full-time W-2 job, that's pretty hard to argue with the IRS. But if you have a part-time job or don't have another job and all you do is spend all your time focusing on real estate, then you do have an argument. There are a set of requirements that you have to follow.
So the best way is for someone to document the hours that they're working on. Is there a certain way that people should be documenting?
There isn't a specific IRS guideline that tells you how to document it, but the more you document, the better. If you have an app or if you just put something on a spreadsheet or even handwrite on a piece of paper, as long as you have documentation, that's going to help your case.
How does having that status change your real estate losses?
So then your real estate losses become active losses. You can deduct it against your other income, so your investment income. If you have other W-2 or business income, you can deduct it against that. That's a pretty powerful tool if you can qualify.
Just maybe as a teaser for people who are thinking about this or planning for it in the future, what things do agents and full-time real estate agents deduct? And also, what are usual things that you see full-time investors deduct or are able to write off?
It's not a lot of difference between a passive activity. It's just that you can deduct these, you can take these losses. And so things like travel, you're traveling to your properties back and forth. If you have multiple properties, you're probably doing a lot of driving. You can take that automobile expense going back and forth, especially now with the price of gas. Then all the other standard, anything that's directly related to your rental properties or your business itself that can be deducted against the income.
What is depreciation?
Depreciation is hard to explain. It's a bit of a misnomer because you think of property as appreciating in value in general, but depreciation is just an IRS code that allows you to deduct your purchase price of your property or anything that IRS deems as a useful life. The property itself has a useful life for the IRS. So for a residential property, that's 27 and a half years. And for commercial properties, it's 39 years. So you can take your purchase price. You have to allocate percentage to land and a percentage to building. The general rule of thumb is you take 20% and allocate to land and 80%. You could use the property tax allocation as well. You take the value of the building or the purchase price allocated to the building and divide that by, say, 27 and a half years. And then that's your annual depreciation deduction that you can take against your rent income. That's one way where the kind of the power of real estate, where you can have positive cash flow but show a loss on your tax return. Perfectly legal. You're showing losses on your return but still actually making money due to that depreciation.
Yeah, I heard it coined as the government's incentive for you to invest in real estate. Are there any differences between having a long-term rental and a short-term rental?
Yes, so a short-term rental, and the IRS defines a short-term rental as any property that you rent on an average of 7 days or less. So if you have a short-term rental, it is considered active income, but you have to meet some certain requirements to be able to deduct that against your other income as well. Short-term property, if you participate, which the IRS defines as 500 hours of participation, then you can deduct that income against your, say, W-2 income. Unlike the real estate professional requirement, it doesn't have to be a majority of your income. It doesn't have to be a majority of your time. So as long as you have those 500 hours, then you can take those. You may actually be cash flowing on it. With that depreciation, you could end up with a loss, and you can take that loss and take that against your W-2 income, your investment income.
Because it's not passive losses, because you are operating midterm rentals, and even more so in a short-term rental space when you have guests coming in every 2 days or so. It's a second job. Can you earn other income while in this kind of gold standard full-time real estate professional status?
You can always have investment income. That doesn't really affect this. But if you, say, have a part-time job or anything like that, you just have to make sure that your real estate business is more than half of your time. And the closer you get to that half, the more it's going to get scrutinized. You really want to make sure it's a majority, more than just 51% of your time. If you get audited and the IRS doesn't like some of your record keeping and throw something out, then you could find yourself in a difficult situation.
How about along the same lines, you have your doctors, your lawyers, and definitely some tech professionals who are high income W-2 earners. What are different ways that they can then offset their W-2 income?
The short-term rental is one way if they have the time to operate it. Again, you have to put in those 500 hours. So if you're spending every waking hour at your other job, then you may not be able to get those 500 hours in. But if you can participate in that property, then you can take that any losses from a short-term rental against your ordinary income.
What about, let's just say they have a spouse. Are there any things that they should be thinking about what their spouse can also potentially do that may offset what they earn?
Yes. So the real estate professional applies per person. So if you have a spouse that doesn't work, but spends all their time on real estate, they could qualify as a real estate professional. And then if they have losses as a real estate professional, can offset the spouse's W-2 income if you file a joint return.
So you're saying that one of the most advantageous positions for people to be in, that almost is, if they have a really high W-2 income, is to have a partner who potentially be and obviously this is not to lose money in real estate, just capitalize on either the write-offs or the depreciation that's allotted to them, to have those paper negatives offset against the big W-2 positives.
Yes, correct.
How often does that happen?
Not as often as you would think. It is not easy to be classified as a real estate professional, and you are scrutinized a little more. There is some apprehension sometimes with clients. With all my clients, I tell them, as long as you do everything correctly and document everything, there's no fear. Nothing to fear with an IRS audit. Some people are still very worried about that and maybe don't want to take that risk.
And there's just a natural anxiety about that all in general. But obviously, if you have someone who's in your corner that knows exactly what you're doing, can vouch for you, there should be no problem.
And that's the value of having a CPA. We'll go to bat for you with the IRS and take that stress off of you.
Would there be any added benefit for both partners to be full-time real estate professionals? I guess not really. If you're married, what's mine is yours?
Yes, yeah. Especially in California, as a community property state in California, others, each own an undivided half of each other's assets and income. So yeah, it wouldn't necessarily make sense to have both as real estate professionals unless that was actually your job. And in this instance, the tax avoidance type of situations wouldn't necessarily want to have both as real estate professionals. The situation would have one have a high income and then use a real estate professional to offset that.
So are there any additional ways that someone can maximize being able to offset their W-2 income aside from just being a real estate professional?
Like I mentioned, the short-term rental, that's one of the biggest ways. Outside of real estate, obviously retirement plans and things like that. That's usually my first question to clients is, do you maximize your 401k or your IRA? Because that's money you're setting aside for yourself. You don't have to spend that money to create a tax savings. You're just setting aside for yourself in the future.
What is that usual MO? Are you maximizing 401k, and then what else are you then maximizing as you go down the list of what's available to them?
It depends. If you're an employee, then yeah, you want to maximize your 401k. That's your biggest deduction available to you. As a self-employed individual, you have a lot more options. You can put quite a bit more. If you don't have a 401k or any of those types of things available, then you can put $6,000 or $6,500 into an IRA. Not a lot, but over time that'll build up and release some taxes. And even if you are maximizing your 401k, there's a bunch of different things you can do. If you don't qualify for a Roth IRA, you can do the backdoor Roth IRA where you make a non-deductible IRA contribution and convert it to a Roth. Doesn't give you an immediate tax deduction, but gives you that tax-free growth, which is just as valuable.
Interesting. And that's available for who again?
For pretty much anybody that has earned income. So as long as you make more than the minimum or the maximum IRA contribution amount, then you can do that.
Just to sum it up, and we're talking about passive versus active losses again. It sounds like if you are in a day job with a W-2 income, if you are self-employed, that is all active income.
Yes.
And then if you are doing very little to none, if your capital is basically making income for you, then that's all considered passive.
Yes.
Am I missing anything else outside of those definitions?
Just that real estate by the IRS's definition is passive. So it may seem like it falls into that first category, but it's passive unless you meet the short-term rental or real estate professional.
Gotcha. And that's good to know. And no matter what, regardless, even if you're managing your long-term rentals yourself, that income is still classified as passive, even if you have a W-2, right?
Yes.
Awesome, Derek. Is there anything else that you want to share about the differences between active and passive income?
If you have any questions, feel free to contact me.
I hope for everyone that's watching that this kind of enlightened and showed you what the differences are between active and your passive income. And if you have any specific questions about your own use case, with the general disclaimers of we don't understand your personal situation, but we can give general blanket information, you can comment any of the questions that you have down below, and we'll answer that in a future episode. And of course, if you just want to dive real deep into your own specific use cases, you can book a link and a tax strategy call with Derek in the link down below. Derek, thanks so much for all the info today.
Thank you.
All right, everyone. We'll see you guys on the next one. See ya.